What's going on, dude? How are you?
Listen, I don't know what you're used to when you go on these podcasts and TV shows and stuff like that. Like, I'm not like your typical. I'm gonna give it to you. I'm gonna give it to you hard. I'm gonna make it hard on you.
All right, I'll do my best.
I'm not just gonna serve up alley-oops. You know what I'm saying?
Allow me to reintroduce myself. Let's go. The JC Show. We the top of the charts to give your thesis a jump start. Don't depart from the art and get paralysis. Technical analysis. You know we handle this. Hey guys, welcome back to the podcast. Today we have a very, very special guest. JC sits down with his good friend, Josh Brown, the reformed broker and CEO of Ritholtz Wealth Management. Josh is a big fan of technical analysis and is friends with tons of technicians across the country. Josh and JC go way back and have been arguing with each other about markets for a very long time. So this was a lot of fun. We hope you enjoy.
Well, let's talk about technical analysis. You ready?
Let's do it. Let's get into it.
All right. So one of the things that I wanted to talk to you about, I mean, outside of, CMTs and technical analysts that we talk to every single day, I'm pretty sure you are the person in this world who knows more technical analysts, right?
People who are technical analysts.
That's right.
Yeah, well, I met probably 90% of them through you, but yeah, I would say that's probably accurate.
Well, that's probably true, but still, even if I'm not part of the conversation, you're talking to Krinsky and you're talking to Ari Wald and John Roque and, right?
Yeah, I have so much respect for all those guys. One of the things about being a technical analyst on Wall Street is that in certain market environments, you're more popular than in others. And I think that makes it a tough discipline because sometimes markets are so good or so easy that you just get discarded and people stop paying attention to, price and week to week data. And they're just focused on like everything's going up and I'm having a blast trading. And then the environment changes and all of a sudden they start looking at technical research again. And I think when you're a technician for a living on the street, you just have to incorporate that in and out of favor thing into just the way you think about your career. Like you're not going to be the most popular person every day.
It's really interesting because from our perspective, we're looking at different asset classes. There's always stuff that's working and then there's also stuff that's not working. And I think one of the biggest benefits of technical analysis is being able to see that. Be like, well, bonds are out of favor, rates are going higher, certain stocks are doing well, certain stocks are not. And I think bringing in that element of other asset classes really helps, where in certain disciplines, you're ignoring that altogether, Are
all technicians looking at multiple markets, or there are some technicians whose job it is just to focus on what stocks are doing or picking individual stocks?
Or just commodities and currencies and not stocks, right?
Yeah.
It depends on your job. And, just sort of taking a step back, I think a big misconception, I know you know this, but a big misconception is what technical analysis even is. Let's remember that what technical analysis is, what technicians do, is analyze the behavior of the market and therefore market participants, as opposed to the goods and services in which a particular market deals, right? So that's sort of like a variation of the definition that Edwards and McGee gave back in the 40s. I would add humans and monitoring the behavior of those participants, not just the behavior of price, but also the participants, where we're including sentiment and sector rotation and asset class rotation into that conversation too.
Sure. It's easy to lose sight of this when you're somebody who's fundamentally driven, where you're sitting on conference calls, you're listening to the executives, you're trying to get a feel for what the other market participants are involved in a given stock or sector are thinking. And so you're having cocktail parties and there's dinner chatter and you're meeting with institutions that are involved in the stock. But like in the end, none of that is really quantifiable. I'm not saying it's not valuable, but a lot of those insights that you're picking up on, if they could be boiled down to one single number, that number would probably just be whatever the price of the stock is. So not that it's a cheat code and it alleviates your responsibility for knowing anything else, of course, but it really does cut through a lot of things that are maybe superfluous, like as far as somebody's investment process. And you only really can believe that if you have adopted the belief that the price is the truth, not the price is right or that the crowd is infallible, but just Like, this is the sum total of how everyone involved in the stock currently feels about the stock. That's what this number says. If you haven't accepted that yet, you eventually will, but that you're throwing up roadblocks that don't need to be there. Mental roadblocks.
It's the ultimate truth as far as I can tell. Humans, CEOs and auditors, they get things wrong or they're just lying to you. Both happen quite often. Analyst estimates are just that. They're estimates. Government data, again, are estimates. They tell you ahead of time that they're going to revise them multiple times in the future. But price is never going to be revised. It really, really is the only truth. And I know you know that because we've had these conversations a zillion times. But as the CEO of Ritholtz Wealth Management, as foreign broker, shout out TRB.
Sorry, let me throw a little wrinkle in there.
Shoot.
Price will never be revised. I agree with you. But sometimes in hindsight, we'll find out that there was a lot of manipulation in price and that some of the market activity that we had been observing was not what we thought it was. But it's hard to do that in shares of Apple and Microsoft, obviously. Easier to do that in a shitcoin with $100 million, market cap. So that's definitely part of the story. But it's probably a smaller and smaller part of the story as you move up in market size.
Yeah, there's no question that as long as you're dealing in liquid markets, because technicians can't go to work in illiquid markets, right? There's a reason why I'm not looking at residential real estate, right? These are illiquid markets, private investments, venture capital. Like, while I do invest in some of those things, it's obviously not my area of expertise with respects to technical analysis and being able to trust price behavior and trust price trends. But why don't we talk about what you guys are doing? What about at Ritholtz Wealth? How are you guys incorporating any sort of trend following or any trend identification systems in what you're doing for clients?
So in two ways. The first is in terms of our communication with clients and with the public. Michael Batnick is my director of research. He somewhat looks at markets through the lens of technical analysis and trend. I think Barry Ritholtz is very similar. Barry doesn't have any formal training at tearing apart balance sheets and reading 10 Qs. It's never how he thought about the market. So supply and demand is a very big part of the ongoing slide decks that we do for clients to just kind of give them a view of what the big stories are, what the trends are, and what's actually happening. And then, of course, my own blog. But a lot of that's very superficial. The bigger thing that we're doing, I think, is on the tactical asset allocation side. We have developed a model internally, which I know you're very familiar with, JC. We call it goaltender, which is a double entendre. On one level, we want clients to think about goaltender as literally keeping the puck out of the goal. So to speak. It's defensive strategy in nature. The idea of it is a rules-based strategy separate from the long-term asset allocation that will flex, either be more in stocks or less in stocks based on the primary long-term trend in the market. And we define that as a 10-month moving average. But being able to do that for clients is not necessarily about the returns alone. Although the returns have had periods where they're really good. For example, this strategy has been fully invested in stocks since May of 2020. So we're proud of it. It's getting the job done, but it's not meant as an alpha strategy. And in fact, if you were to add 2 and 20 to it, it would wreck the whole benefit of using it. So that second part of the double entendre, when we call it goaltender, what we're really trying to do is the psychological component of long-term investing for our wealth management clients and tend to their real goals. And our clients' real goals are not crushing the market. That's not important to them. What's important to them is retiring, taking care of their children, leaving a legacy for grandchildren, not having to worry about, how do we pay for a catastrophic illness in the future, all kinds of different goals. And those are the goals we're really tending to. How does technical analysis play into that? I like to think of goaltender as a tool to fight FOMO and as a tool to fight just, regular fear. So it works in both directions. In a bull market that's in a relentless uptrend where new highs, we had 70 new closing highs in the S&P last year, for example, one of the best years on record, max drawdown of 5.7% and 70 days in which stocks closed at a record high. How do you keep a client from feeling like they're missing out and wanting to jump and do something even crazier, like put all their money in an ARK fund, for example? Well, the way you do that is keep them as fully invested as possible. And that's what Goaltender has allowed us to do in bull markets. In a whipsaw, it's very tough because we're making monthly decisions on how long we're going to be, and you can get tricked a lot. So a flat market is a biggest challenge for us. And then in a defined downtrend, same as for all technicians, like that's the easiest market to manage Goaltender in, because you're getting these 3-day rallies that trick a lot of people who are looking at day-to-day action, and you're focused on 30-day time periods. And maybe you're not getting caught up in as many of those fake bear market rallies. And you're in a strategy that's designed to keep you out of a longer-term defined downtrend. There hasn't been one of those for a while, I would point out. But that's what Goaltender is designed to do. It's typically somewhere between 10 and 20% of our typical multi-million-dollar client portfolio. So it's not something where we're betting the ranch on signals, but behaviorally, it's really helpful. And if it can add a little bit of upside in certain market environments, that's great, but it definitely doesn't need to. And the main thing it's designed to do, again, is be the emotional release valve in both directions, up and down. And from that perspective, it's been very, very helpful for our relationships.
As far as I'm concerned, Josh, and I've been having this conversation a lot for other reasons, because we're doing like a crypto sort of version with that, but that's another story. This has to be, that 10-month moving average strategy has to be the most old school trend following strategy I may have ever heard about. And you're never going to sell at the top. You're never going to buy it at the bottom, but you're going to be able to take big chunks along the way. And also, there aren't that many trades. If you go back to 1950, there actually are much fewer trades than you would think. Because we've done the research. I mean, it really is fascinating. It definitely increases returns, lowers volatility, and again, there aren't that many trades. That definitely has surprised me about that strategy.
You nailed it. Now, we're not just doing straight up, simple moving average 10-month. First of all, it's all U.S. stocks, but it's not all S&P 500. So a lot of the challenge there was to look at the back tests and try to get a feel for like what's true about the back test that might not be true anymore going forward, and throw that stuff out, because just things change, right? In the way that indices are calculated and in the way that indices are allocated. And, don't forget, these are predominantly indices that are being managed by a human investment committee. So just being real with clients and saying, here are the limitations of a back test like this. That's a really big part of it. The second part of it is asking yourself, are tops and bottoms symmetrical? And of course, they're not. We know that tops, not always, but major market tops, like the ends of major secular bull markets historically, they've been rounding. And that actually makes sense when you think about the psychology. People gradually give up on bull markets. They don't all agree on one day, this is over. And so you get these kind of rallies back to a lower high, and then a sell-off, and then another rally back to an even lower high. And what that looks like on a chart over an intermediate or a long term is a dome, right? It is like this rounding, gradual give up.
It's a frowny face. You sell the frowny faces. You buy the smiley faces, sell the frowny faces.
That's right. But bottoms don't look like that. Bottoms aren't rounded. The big ones. Go back through the end of some major secular bear markets, and look, nobody announces the bottom in advance, and you don't even know it's the bottom while you're going through it, of course. But in hindsight, they're sharp, they're V-shaped, they're they catch people off guard because of they almost arrive like typhoons. Like, you can't model when a typhoon's going to come. It's just one day, oh my God, look at what's developing out in the ocean. It is very hard to see that coming. So if you say to yourself, okay, a top is more gradual, maybe there's a little bit more time to pick up on it so that our signal to sell could be slower. But then you say, man, if you miss the first 40% of one of these end of a bear market, start of a new bull market, you kind of fucked yourself. Like you missed a lot of the whole reason of being invested. So then maybe you have to go exponential on your moving average versus simple.
Yeah.
So that's like a very minor adjustment of that old school 10-month. But if you look at what that does for you as an investor, there's a huge difference there. And then the second thing is diversifying the timing of your signals. If you look at March and April 2020, if you went all out like at the wrong time, like at the end of April, if you went completely all out and then waited to get back in, you might have negated the whole point of being tactical to begin with. You might have missed so much of the rally before a signal let you back in. So we're trying not to be all in, all out to the extent that it's like 100% or 0%. And diversifying the timing of the signals has been a really good tool to mitigate that. And again, this is not about like best performance. This is about keeping clients from jumping out of a building thinking it's on fire or jumping 100% into whatever the hot investment is because they feel like they missed out on everything. So we're really, when we pitch this to clients, we never pitch it as this is going to crush the S&P. We always explain it as this is the thing that's going to let you sleep at night in a downturn and going to keep you feeling like you're part of the game in a bull market. And if you're honest with clients about what the strategy can and can't do, to your point, those big chunks, it's enough. Like it's enough for clients who are reasonable. If you pick the right clients, they're not expecting, I never want to lose money, but I want all the upside. Like we would never.
But people actually do expect that. Some people do think that.
Yeah, but so that person doesn't get far into our process to become a client. Like we pick up on that early.
All right. So this is a really important topic as we enter 2022. And that is the exposure that investors have to different types of stocks. And when we talk about home country bias, you personally, and we'll make fun of you, you have home country bias, you have New York City bias, you have Long Island bias, you just
everything,
oozing,
all the biases.
You ooze it more than, it's hilarious. But let's think about it from the perspective of US investors in general. Somebody that owns like the S&P 500, where you're going to have a ton of these massive mega cap growth names as part of that exposure: Apple, Microsoft, Amazon, Google, Facebook. That's just the composition of what's inside of the United States. If you look at the S&P 500, if you own the S&Ps, only 5% of your portfolio is in energy and basic materials. If you own the Dow Jones Industrial Average, that number drops to under 3%. And if you own the NASDAQ 100, your exposure to energy and materials is 0.0%. Not to mention, the definition of the NASDAQ, I don't know if you knew this, but the actual definition of the NASDAQ is the largest 100 companies that are not financials. Like they actually exclude financials in the definition. So you're obviously getting zero exposure there. And I think only like 2% in industrials. So depending on what index you're exposed to, even if you're in the most diversified in the S&P 500, you still don't have any materials or energy. And energy was the best performing sector in the S&P 500 last year. Not to mention, in a rising interest rate environment, the best performers are financials and energy, right? So as investors, as a financial advisor, how do you have this conversation with your clients as far as exposure to things that are not growth, high multiple?
First of all, I'm going to call bullshit on that whole premise that NASDAQ is non-financials because
that's a definition. It's a definition.
I understand, but the world has changed and they haven't kept up with that change.
Fair. PayPal, all right, I'll give you that one.
PayPal is a $220 billion market cap. It trades on the NASDAQ. It's in the NASDAQ 100. It's one of the largest companies in the world. It's bigger than Goldman Sachs. It's bigger.
Yeah, but
than
it
Morgan
doesn't.
Stanley.
But it doesn't trade like financial stocks. It trades like tech stocks. If you take a look at.
However, just because they're delivering financial services via an app as opposed to via a lobby with marble columns doesn't change the fact that it's one of the most important and widely used financial services company in the world. Venmo
but the stock market treats it as a tech stock. It doesn't treat it as a bank.
That's okay. It's still a financial company that's miscategorized by the committee. And there are a lot
investors,
of examples.
Clearly.
There's a lot of examples of this. I'm just going to tell you that there's going to be this convergence where Goldman Sachs is spending as much on technology R&D as Square And why is one in one index versus one in the other? Because one is 100 something years old. Like, all of these indices and sectors need to be rethought in the age of Web 2 and Web 3, because these companies and the leadership of these companies do not respect those categorizations. They don't give a shit. They are following their business into wherever they think they need to follow it. And sometimes that means a company like Walmart selling life insurance. And sometimes that means a company like JP Morgan doing virtual banking with the Zelle app. And it's all converging into this idea that every company in existence is a tech company. And a lot of companies being called tech companies really are in a different business than you might think. So,
all right, now do energy.
That's my spiel.
All right, do energy.
Okay. Energy 10 years from now, people think of the terms energy and oil as being interchangeable. There might be like 10% weighting toward oil in 10 years in the energy index, and they might be almost entirely solar, natural gas, nuclear, and wind.
Okay, but we're talking about 10 years from now. I'm talking about energy was the best performing sector last year. And when I mean energy, I mean oil and gas, like old school, dirty, disgusting oil and gas. Best performing sector last year. Off to a strong start. And if interest rates are going higher, energy is probably going to do well. So I'm talking about from the perspective of an investor, not a hypothetical situation 10 years from now, not what a CEO decisions they're making, that they're all tech stocks. I'm actually talking about dollars and cents exposure to these companies from investors, right? As a financial advisor who talks to investors of all kinds, I can imagine, to be able to look at the S&P 500 and be like, listen, the energy sector could triple and you're not going to make any money this year because you're not in it, right? How does an investor think about that sort of exposure today? Not 10 years from now. I don't disagree with anything you're saying. I'm talking about today, like in practicality.
Okay, so in practicality, let's do this global stocks versus energy. Let's make it a little bit more fair. Being practical about this, the question is, what is the time frame that matters? Is it how you did over 1 year, or is it what's the bigger story? The really big story with the energy select sector spider is up 20% over the last 10 years, which might as well be zero.
Right, but you're anchoring to the top of the commodities bull market, Josh. So like it's like, it's like the gold bugs that are like zoom out to 2000.
I'm not selecting a specific window of time. I'm saying, like, if you're a long-term investor, is 10 years or 1 year more important? Obviously 10. If I said 12,
you can't just use an arbitrary rolling 10.
All right. Well, how far back do you want to go?
Well, because the rolling 10 takes you back to 2011 when commodities peaked. So it just so happens that 10-year period for this particular conversation skews the data dramatically. I know you're not a moron. I know you understand this.
Of course,
you're being fresh.
But all right, so let's do 5 years.
Fine, 5 years. So if energy represents such a small percentage,
JC, hold on, stop. 5-year period. Let's say, as an advisor, you built a client portfolio where energy was just equal weight with whatever it is in the benchmark. The energy select spider over 5 years is flat, literally nothing. The MSCI world stock market is plus 94%. US stocks is even more. So you might have underperformed being underweight or equal weight energy last year. That's true. You're right. But that's last year. Bigger picture, these stocks have shrunk as a percentage of the market to the point where it's unrealistic to think they'll ever regain the weighting they once had. When you and I first met, energy was 12 or 13% of the S&P. Last year, it fell to 1%, and then I think it rebounded back to 2%.
Yeah.
Or whatever it is. It's not going back to 12 until this sector is solar panels, and it's not yet. But
how do you know it doesn't go back to 12? What if we're in the early cycles of a commodity super cycle like we've seen before that go on for a decade plus? And what if we're in the early stages of this as an investor, you missed that?
I'll tell you how I know.
How do you know?
How I know? Virtually everyone tracking usage of oil, not stocks, not commodity prices, but actual end usage. Virtually everyone's numbers are the same. By 2025, a quarter of all the cars being sold will be powered by lithium-ion batteries. And by 2030, there may be no cars using combustible engines on the market anywhere in the United States or Europe. If let's say that's overstated. If that's even 50% accurate directionally, that's how I know that oil companies dominating the XLE will never get that sector back to being 12% of the S&P.
Let's take oil out of the equation for 1 second and just talk about natural resources in general, right?
Yeah.
Including base metals and copper, just not the chemicals, right? Chemical stocks are making new 52-week highs. I don't know if you noticed. All-time highs,
Commodities are a bet against human innovation.
You wouldn't agree that it goes in cycles?
Oh, I 100% do agree.
And that if we're in a rising rate environment, those are the types of names that are going to outperform, not the names that have done well recently.
All of the innovation that's going on and has always been going on, one of the most obvious consequences of trillions of dollars worth of R&D is lessening our usage of as many resources as possible. Like getting more out of less is one.
So that's it. You think there's no chance that we have a 5 to 10 year stint where these natural resources are outperforming those higher growth areas?
No,
you think there's
that's
no
not
chance?
What I'm saying. I'm talking about end usage. Let's talk about the stocks. Here's what's ironic. Biden's policies actually could drive oil prices substantially higher because they are biasing spending away from developing more natural resources. So actually, JC, I agree with you. We could have massive upcycles in price for things like crude oil because of how little drilling and how little capacity there ends up being in a situation where the tax code is being written to disadvantage or to discourage more development of that type of energy exploration. So I don't actually think that it's as simple as, oh, more electric cars, lower oil price. I don't think that at all. And in fact, I think a lot of the price gain last year came from a very simple fact, which is the CEOs of these energy companies, for the first time in a long time, actually had positive cash flow. And so they were in no rush to rush and meet that demand and start drilling all over the place. They were actually pretty happy with this idea of seeing their share prices go up. And so you actually had less development than you normally would in an environment where the price of oil goes from 0 to 70 a barrel. So that's a really interesting reason why you could be dead right about what could go on.
So then let me take a stab at this, because I think we've had this conversation privately in the past, prior cycles. Your solution here, right? The prescription, right? So we talk about, like, shout out Phil Perlman. We have the descriptive process, and then we have the prescriptive process that people like to avoid. You believe the prescription is if you do have exposure to the broad indexes and energy and some of these basic materials do take a larger portion of the overall weighting, you're going to grow with it, essentially?
Yeah, I'll get paid for that. I won't have the hedge fund that makes the cover of Fortune magazine because I put 80% of my assets in oil and the price of oil doubled. That, like, I won't have the photo shoot. But if there is a commodity bubble, whether it's gold in 2011 or oil in 2005 or whatever the hell comes next, if there is a true super cycle to the upside for any particular commodity, my bet would be that will manifest itself and show up in the S&P 500. And I will ultimately derive some of the benefit of that. And people might say, like, oh, that's a cop-out. Well, what's the alternative? Me pretending I'm fucking Stanley Druckenmiller? Like, to me, that's just a more reasonable way to be, like, accepting of this premise that commodities super cycles in both directions exist. I don't think that I can predict them. And I don't think if I happen to have caught one, that I would be a good enough technician to know when it's coming to an end and radically shift my client portfolios. So I just try to stay out of games that I don't think I can win.
All right, here's an alley-oop for you. To quote Michael Batnick, I think gold is broken.
It is. It is broken. It's been broken for a long time. I don't ascribe the entirety of that story to Bitcoin. I think gold got permanently disrupted in the early 1980s. And it took 35 years for people to figure that out. If you think about the way that gold originally was used, gold was a communication tool. Take the store value part out. You had the Silk Road before there were cell phones, before there were fax machines, telephones, any kind of electronic communication. The Silk Road was an early technology, and it's how people were able to trade from Europe to China and the entirety of the route in between, right? All up and down the Silk Road. And what gold did was it was like a universally accepted thing that had value, so that you didn't have to walk 15 camels 900 miles to sell them. You could sell the camels within 3 miles, and then you sold it to somebody who then would take them in exchange for gold, and then they could buy carpets and they could sell those for spices, and the spices sold for gold, and then you could take that gold and on and on. And so when you think about it as a technology, it's a communications technology. Everybody all up and down the Silk Road said, okay, gold is the thing that I can exchange all of my things for. And then I know I can use that to buy other people's things. That was really important for human development. And it stayed important for thousands of years. Now, the reason it was so important is because somebody in Saudi Arabia had no idea what somebody in Greece was paying for a bushel of barley or whatever the fuck. Like it was impossible to know what the values were over those vast distances in anything even approximating real time. In the early 1980s, all of a sudden computers started to appear on trading desks around the world. And it was possible for the first time in human history for everyone in Tokyo, in London, in Switzerland, in New York, to understand what everything was worth at a given moment, all at the same time. So this is the advent of the information technology revolution. And JC, it's not a coincidence that at that exact moment, gold prices peak in inflation-adjusted terms, never to have seen those levels ever again. The inflation-adjusted price of gold in 1981 or 1982 has never since been repeated in the gold market. On a nominal basis, it has, but not on an inflation-adjusted basis. I don't think those two things happening in the early 1980s are a coincidence. So I think gold was disintermediated as this fabulous tool to communicate a universal value by the information technology revolution. And I think what's gone on in the last 2 years with Bitcoin is really just that realization dawning on people on steroids, kind of all at once. And that's my story. I'm sticking to it.
I bet you're a huge hit at the gold bug parties.
They fucking chased me out of a conference in Vancouver, and I didn't even tell that story. You know what I did? I put up a chart of the gold ETF being worth more than the spider, the S&P, which it temporarily was. And I said, this is a once in a lifetime moment. That is the biggest sign of a top I have ever seen in my life. And I was never invited back. And Tommy Humphreys will tell you that's a true story. But listen, Michael Bannock put up a chart the other day in Slack. There was a moment in 2020 where Zoom was worth more than Exxon Mobil. Now, I didn't see that chart in real time, but that's an actual thing that happened. That's like one of those same type of thing. When GLD was worth more than SPY, it lasted about 2 weeks. And then once that started to revert, it just was so obvious to me that we had seen the peak of something. So, you know, that doesn't happen that often with things as big as gold.
I think it's hilarious that you mentioned the Exxon Mobil, because the crew over at Dow Jones must have seen that, because they kicked Exxon out of the Dow right at the perfect time when you needed to be buying Exxon Mobil. Isn't it funny how that happens?
When Zoom came public in 19, Batnick tells us Exxon was worth 21 times Zoom's market cap. Think about this. Exxon was 20 times bigger than Zoom. That's 2019. In less than a year, Zoom's market cap eclipsed Exxon. That's how unbelievable not only the rally in work from home stocks, but the sell-off in oil stocks. And now Exxon is about 5 times bigger than Zoom, because of course Zoom has been absolutely destroyed and Exxon has had a massive rebound. There's probably still some room somewhere between 21 times larger and 5 times larger, which it is today. But I just find that to be like just this amazing story. You could look at those market caps and look at those charts, and there are multitudes to be learned from a story like that. And that's not a 10-year or 20-year thing. That all took place within like an 18-month span of time. It's really, truly remarkable.
You and I think we've been doing this long enough at this point where nothing surprises us anymore, right? Like, are you ever surprised by anything?
Yeah. Crude trading at a negative number is this thing now where for the rest of my life, anytime I hear somebody say never.
Right.
Really never? Are you sure?
I would agree with that. To me, I thought I had seen it all, especially after the 2008, right? I thought I had seen it all. And then once oil traded below zero, I was like, oh, okay. Okay, got it.
Yeah.
Got it. So anything can happen? Got it.
Yeah. Don't tell me never, ever again. I just watched a barrel of oil change hands for negative $30. Never say never to me ever again.
That's exactly right. All right. So then what about you? So those are a few things I had on my mind. Going into the new year, what are you thinking about? Like what's on your mind?
I think I'm probably like everyone else thinking about what happens to risk markets when there's an actual cost of money. How quickly will the Fed try to normalize rates and then normalize its balance sheet? Will it be stupid enough to try to do both of those things at the same time? How much time will the Fed allow between interest rate hikes to let markets adjust and actually study what happens versus doing a quarter of a point every meeting just because, they can? Like I guess I'm most curious about how patient the Fed will be at normalization this time. And I wrote something today about 2018. They really made the mistake in 2018 of trying to do a rate hike every meeting and let $400 billion worth of bonds mature and not replace them, or what's being called quantitative tightening these days. And it was a disaster. They ended up inverting the yield curve a year later. There were two 20% crashes in stocks during the year 2018. And that's against the backdrop of pretty good GDP growth. And it's right after one of the biggest tax cuts in history took effect. So we know that monetary policy was flawed. And the reason we know is they quickly unraveled it and reversed it. And then by 2019, they were already cutting rates again. So it's like, is Powell, who was the guy at the time, did he learn anything? Or is he going to try that again this year? I don't think he's going to try that again this year. And I know that this week, all the talk was about like, oh no, they said they're going to let the balance sheet run off. No, they actually didn't. One person in a meeting brought that shit up. The market got so spooked from that. And the media obviously stokes that fear. I have a hard time believing that the Fed thinks it's in its best interest to go fast. So, and I know you don't like focus, you don't personally focus on Fed gossip and all that shit, but my clients are hearing all these headlines. So I have to have good answers for them about what this might mean, what that might mean. Even if I don't think it's particularly meaningful, enough people do that I have to be able to speak about it. So that's definitely, I think, the main thing that most people are focused on right now. Will it turn out to have been not that important? Probably. Most things are. But I'm still very much drowning in that stuff today.
Yeah, it's not that I don't care about the Fed gossip. Like, what did he say? What did she say? I'm more interested in what on how the bond market is reacting to that, not a Fed whisperer or whatever they call these people that follow the Fed very closely. Like, I'm more interested in what's actually happening, not somebody's opinion. And you can see that in the bond market. You're seeing 1 year, 2 years, 5 years, 7s, 10s, all making new highs, really all pointing to, I think, back to those 2018 highs around 3%. That could be where they're all heading. And, going back to when you and I first met, 2004, 2005, 2006, what were the types of stocks that did well in that environment? Merrill Lynch, Bear Stearns, Lehman Brothers, AIG, Halliburton and Transocean and all these big energies, energy, financials, more of the value-oriented areas of the market versus, growth and technology, which were underperformers in 2004, 05, 06. Why can't we see something similar?
Yeah, I think if you think about the aughts decade, which, on balance was basically a disaster. You had two 50% S&P crashes inside of 7 years. just absolutely traumatic. But biotech had a big moment coming out of the '02 bottom. Biotech in '03 and '04, probably the best growth-oriented sector in the world, way better than anything in regular technology, for example. And then you also had this parallel thing going on with real estate and rates and private equity LBOs. There were, just like we have an IPO every day now, back then there was an LBO every day and some very big companies going private. So you had some interesting trends going on. But like, if you think about this year as being a continuation of last year, but with gradually rising rates, to me, that's probably the right way to think about it, because some of the biggest trends driving the economy and the markets are not turning on a dime just because the calendar turned over. So I think demand for housing stays strong. When you do a screen, what stocks are within 3% of their all-time highs? All the building and material companies, anyone doing HVAC, anyone doing roofing stuff or whatever, those are the stocks littering the new high list, the all-time high list. Companies like Masco making wallboard and sheetrock, Eagle Materials. I just bought this thing, A.O. Smith, which makes hot water heaters. Like, all of those stocks are in these massive uptrends. Just because the calendar goes from 21 to 22 doesn't mean that would end necessarily. And then the other big trend is consumer demand for everything. Household balance sheets are in the best shape they've been in since we've been in this business. Like, people have money. Like, a lot of people have a lot of money and they're spending it. So I think a lot of consumer discretionary can keep working. It doesn't mean that'll outperform banks and energy. I'm just saying there could be very large parts of the market that continue on the trend that they've been on. Just because it's a new year doesn't mean you need a whole new approach to investing.
Yeah, no question. A quiet second last year in terms of performance was REITs. I thought that was interesting. A quiet second place in an environment that rates are rising. You would think
REITs went up 40% last year or something.
Unbelievable. Just
unbelievable.
Absolute beast on the REIT side. Listen, before I let you run, Josh, you know, it's you got to give the kids what they want. I want to know what you're thinking about crypto. Is this massive bubble that's about to all fall apart? Or is this here to stay?
You're not going to learn anything from me about crypto.
I know who I'm talking to. I'm talking to you. You're not a diamond's hands, you know, the thing with the eyes, the laser eyes. You're not one of those. I know that. You're a financial advisor.
That's why I'm still working for customers. By the way, that's why I'm still working for a living.
Right.
If I had been one of these laser eye people, I might be done by now. So no disrespect to anybody.
So because I know who you are and the perspective that you bring, I'm more curious on your thoughts than I am on the laser people.
What? Well, you know how the laser people feel. We are thinking about crypto in terms of it being an investable asset class, but not an essential one. So we have clients who are curious. They want to be invested. We really didn't have a good way to help them do that. So we've been telling them for 5 years, do it by yourself. That's not what they're looking for from us. So this year, we partnered with WisdomTree, and we built the first ever separately managed account strategy that's based on an index. The index is called the RWM WisdomTree Crypto Index. And if you're on Bloomberg or whatever, and you want to look up the index, it's RTREE, RTREE. And basically, this is Michael Batnick and my research team working with Jeremy Schwartz and his research team. And the idea was, we don't want to just do a Bitcoin fund because that already exists. And if this is really going to be an asset class, then we want to have exposure to the things that could be the next Bitcoin, right? Like Bitcoin on a back test looks amazing, up 6 million%. Okay, great. Okay, great. Is that likely to happen in the next 10 years? Probably not. So I think we made two really smart decisions. The first is we made inclusion rules-based. So WisdomTree has an index committee for crypto. They are investing a lot of time and energy and money and bringing in a lot of talent to do this. But, you know, their legacy has always been in smart beta and factor investing. So they've got basically a rule, a criteria for what tokens or coins will make it in. One of the main things is like there has to be a point to the token. And then we want some diversification. So some of the stuff is DeFi, some of the stuff is gaming, some of this, whatever. And then like the weighting, this was really key. So it starts off where Bitcoin and Ethereum are the two largest holdings, and that makes sense from a market cap perspective. but we did a modified market cap. We knocked them down a little bit to make room for some of the other protocols that we're investing in. But then we said no rebalance. So this is a free floating index, which means, for example, Bitcoin has just had a horrific 2-week period, but not every token we're invested in has. And in fact, some of them have gone up.
Right.
So Bitcoin then ends up fading in importance in the index, just as it's been fading in importance in just the whole overall market cap mix. So by not rebalancing and keeping Bitcoin at 60% or whatever, and just letting it free float, what if Solana ends up being like twice as important today than it was? We don't want to rebalance and sell Solana. We want to let that thing float higher. If it's floating higher in the real world, meaning more and more people are using that protocol to build things and trade things, then we want it to grow in our index. We want the index to reflect the reality of the crypto market, not conform to some sort of, arbitrary, we think Bitcoin should always be 60%. So that's how we built this thing. Right now, it's only available to Ritholtz Wealth clients, but I'm told in the next week or two, we're going to open that up to every advisor in America to be able to put their clients into it. The custodian is Gemini. So there's a lot of information on the web about it on Wisdom Tree's site. But so to answer your question, how do I feel about crypto? I still think diversification is the right answer. I still think let the market say what the market's going to say. So if there's a token that goes from being 1% to 10% of all crypto assets, my index hopefully will reflect that, and that will be good enough for my clients.
It's a similar mentality to the S&P 500 that I always say is the greatest momentum strategy ever, because it buys more and more of the best ones and kicks out the worst ones. Is it kind of like that?
Exactly. There are tokens and coins and protocols in my index today that may not be in the index in 6 months or in 3 years, just by virtue of the fact that their price and their market cap fades away and other coins are on the rise. And so our index will hopefully be able to reflect that through a combination of the free floating market cap weighting and the work that Jeremy's index committee does on inclusion. So that's the general idea, is that to a certain extent, it will look like an S&P 500-esque de facto momentum strategy. And again, the idea is not let's crush the crypto market. The idea is let's give clients diversified exposure to the overall crypto market and give it to them in a way that's like explicable. Like they understand, why do I own this much of this and that much of that? Well, here's why. This is what the actual activity in the real world looks like. And the index is trying to reflect that.
Love it. I love it. I love the fact that you guys are getting involved with that. Speaking of getting involved,
wait, are you able to chart my index yet? Like, are you able to pull that data from anywhere?
Send it to me. I'm happy to. Yeah, I would love to.
I don't know how to send it to you, but you guys do an amazing job on those rundowns of what's going on in the crypto markets. If this index becomes more accepted by the advisor community, which I guess there's a shot that it could, then arguably it could become an important thing to track in terms of what's happening in that market. So it would be interesting to see how this thing does as time goes on.
I love it. I mean, I could picture in my head sort of what this looks like. 100%. We'll definitely talk about that. And I have a call with Jeremy coming up also, so I'll talk to him about it. But listen, before I let you run, talk to me about California. We're partying out there in September.
Yeah, I'm glad you mentioned it, and I'm so glad that you'll be out there. This is called the Future Proof Festival, and it's basically fintech, wealth management, trading, next generation apps. Like, everybody's going to be there. We've got, I think, 40 or 50 major sponsors already. We've sold tons of tickets, and we've barely even started to announce speakers yet. But we have announced Howard Marks will be out there. A lot of your favorite podcasters are going to do live versions of their podcasts out there. Patrick O'Shaughnessy, for example, is going to do Invest Like the Best. Barry Ritholtz will do a Masters in Business out there. So it's going to be an outdoor festival. It's not in a ballroom. It's not in a conference room. There'll be a lot of great opportunities to network, meet people who are working in areas like crypto and software as a service and everything in between for the financial industry. And we hope to see as many people there as want to go. So it's September 11th through 14th in Huntington Beach.
The weather's probably going to be pretty good, huh?
That's what they say. I mean, that's like one of our biggest risks is it's an outdoor festival, which sounds great. Hopefully the weather will hold up, but I think it will.
So not like the Firefly thing?
God, no. If this goes well, people will say it's the South by Southwest of finance.
Oh, wow.
Well, I mean, we haven't done it yet. So
what kind of people? Like you, me, and Backnick?
Like, hopefully, if we pull this off and all of the corporate sponsors that have committed to this, if they feel like it was successful for them and all of the attendees feel like they met a lot of people and learned a lot, and all of the speakers felt like they got to say like important stuff that was meaningful to them. Like if that's, and we have like great musical acts and there's going to be a bar crawl one night in town in Huntington Beach. Like if all of these things go off without a hitch and people go home with smiles on their face, then this could be the start of like a really big annual event. But you know, who knows? We're really gonna put our best foot forward and try our best.
Listen, I'm bullish. Last time I went to one of your events was a few years ago, and I was like backstage with DJ Scribble. Like I don't know what was going on. I'm like, this is fantastic. So I'm bullish.
We're gonna try to bring some big musical acts and make it a lot of fun. Look, I've been to every conference you've ever heard of, and I know you've been to a ton of events too. And the one thing that I'll tell you is, if your event is living on continuing education credits, you're dead. So
is that still
you're dead? You're done because we all learned in the pandemic that all that stuff can just be done on a computer and save everybody a lot of aggravation. If you're honest with the attendees and you say, "Look, yeah, you're going to learn stuff, and we're going to put great content on the stage, of course." But the real reason to come here is because your career is going nowhere until you meet people. Like you can't be an island and you can't live in the middle of nowhere and not network and not hear from people live in person what's being successful for them. Like you have to do that for professional development. So what if instead of going to 8 events and hoping you might meet one person at each one, what if you went to like 1 or 2 and they were so massive that everybody you want to meet is at them? So I think that's what's going to happen with these events. Events are going to have to scale up to stay relevant. So Matt and John are our advisor circle. They're the main event company putting this on. They're the guys behind Inside ETFs. They ran that event for, I guess, the last 10 years or however long that's been going on. And this is the new thing they want to do. And we're just thrilled to be involved with it.
I love it. So this is September 11th through 13th, 2022?
11th through 14th, 22. We booked out all 4 hotels in the city of Huntington Beach. And those room blocks are open now. Registrations are open now. No matter who you are, there's a category for you to register. So hopefully there's a big technical analyst turnout. That would be pretty cool to see.
Well, I'll do my part to bring some of the homies. I'll definitely be there. Definitely a bunch of guys on my team will be there. We got a big crew down in Southern California, so it's an easy drive for them. And the rest of us will fly out from the East Coast. By the way, Josh, I really appreciate you always bringing me onto the compound. Every time I'm on, you know, my inbox gets flooded in with people that are just, you know, hilarious stuff that I get every time I'm on.
We got to get you back this spring for sure.
Yeah, April, you said, I think, right? Or March?
Like March, April. We'll get you on the calendar.
All right, I'm in. All right, ladies and gentlemen, Josh Brown, the Reformed Broker. Go to reformbroker.com, CEO of Ritholtz Wealth Management. Check him out on YouTube. What, at The Compound?
We're youtube.com/The Compound RWM. Tons of JC on that channel.
Yeah, a lot of JC. Leave a comment on there. Join some of the hilarious things people are writing. JV, thanks for coming in, man.
All right. Love you, brother. Have a good weekend.
Yes.
Bye, everyone.
Boom. That's today's podcast. We hope you enjoyed that. Make sure to drop a comment below and be sure to subscribe to our channel so you never miss an update. To catch up on prior episodes, you can go to allstarcharts.com/podcast and check them out there. Also, be sure to say hi to JC across the interwebs at Allstar Charts on Twitter, StockTwits, Instagram, and YouTube. Catch you on the next one.